have you ever wondered what keeps a business alive and thriving? It's like asking what makes a heart beat. Two powerful forces are at play: accounting and finance. Accounting is the language of business. It tracks every dollar coming in and going out. Think of it as a meticulous record keeper, ensuring everything is accounted for. Finance, on the other hand, is the art and science of managing money. It's about making smart decisions with the money you have and planning for the future. Together, accounting and finance form the bedrock of a successful business. They provide the insights and tools needed to make informed decisions, secure funding, and ultimately achieve financial stability and growth. Imagine a business without a clear understanding of its financial health. It would be like sailing without a compass, navigating blind in a sea of uncertainty. Accounting and finance provide that compass. They help businesses track their performance, identify areas for improvement, and make strategic decisions. Stakeholders, including investors, creditors, and employees, rely on accurate financial information to make informed decisions. Investors want to see a return on their investment. Creditors need assurance that the business can repay its debts. Employees want job security and fair compensation. Effective accounting and finance practices build trust and transparency, essential ingredients for any successful business. Every business has a cast of characters with a vested interest in its success. These are the stakeholders, the individuals or groups who can affect or be affected by the business's operations and financial performance. Internal stakeholders include employees, managers, and owners. External stakeholders include investors, creditors, suppliers, customers, and the community. Each stakeholder group has unique information needs. Managers need detailed, real-time data to make operational decisions, which falls under managerial accounting. Investors and creditors rely on summarized historical data presented in financial statements, which is the realm of financial accounting. Understanding the different information needs of stakeholders is crucial for effective communication and decision-making. Imagine a world where every business followed its own set of accounting rules. It would be chaos. Comparing financial statements would be like comparing apples to oranges. That's where generally accepted accounting principles, or GAAP, come in. GAAP is a set of standardized accounting rules, guidelines, and procedures used to prepare financial statements. These rules ensure consistency, comparability, and transparency in financial reporting. By following GAAP, businesses provide stakeholders with reliable and understandable financial information. GAAP is like the rulebook for financial reporting, ensuring everyone is playing by the same rules. Section 5. The financial picture, income statement, and balance sheet. Two essential financial statements provide a snapshot of a business's financial health: the income statement and the balance sheet. The income statement, also known as the profit and loss statement, shows how much money a company made and spent over a specific period. It includes revenues, expenses, and net income. The balance sheet is a snapshot of a company's assets, liabilities, and equity at a specific point in time. Assets are what the company owns, liabilities are what it owes, and equity represents the owner's stake in the business. These two statements work together to provide a comprehensive view of a company's financial performance and position. Section 6. The flow of money, cash flow, and liquidity. Imagine a business with a healthy profit on its income statement but no cash in the bank. This scenario highlights the importance of cash flow and liquidity. Cash flow refers to the movement of cash in and out of a business. Liquidity refers to a company's ability to meet its short-term obligations. The statement of cash flows tracks the flow of cash from operating, investing, and financing activities. The owner's equity statement shows changes in the owner's stake in the business over time. Understanding cash flow and liquidity is crucial for managing working capital, making investment decisions, and ensuring the business can meet its financial obligations. Section 7. Measuring success, key financial ratios. Financial ratios are powerful tools that provide insights into a company's profitability, efficiency, and financial leverage. Profit margin measures how much profit a company makes for every dollar of revenue generated. Return on equity, or ROE, measures how effectively a company is using its equity to generate profits. Debt-to-equity ratio measures a company's financial leverage, indicating the proportion of debt used to finance assets. These ratios are calculated using information from the financial statements. For example, profit margin is calculated by dividing net income by revenue. By analyzing these ratios, investors and creditors can assess a company's financial health, compare it to industry peers, and make informed investment and lending decisions. Section 8, the money machine, Federal Reserve, banks and interest rates. The Federal Reserve, or Fed, banks and interest rates play crucial roles in financial lending and the overall economy. The Fed is the central bank of the United States. It sets monetary policy, regulates banks, and provides financial services. Banks act as intermediaries between lenders and borrowers, facilitating the flow of money in the economy. Interest rates represent the cost of borrowing money. When the Fed lowers interest rates, it becomes cheaper for businesses to borrow money, stimulating economic growth. However, lower rates can also lead to inflation. Conversely, higher interest rates can slow down inflation but may also hinder economic growth. Credit analysis is the process of evaluating the creditworthiness of a borrower. Lenders use the 5 C's of credit: character, capacity, capital, collateral, and conditions to assess the risk of lending money. Section 9. Fueling growth. Financing options. Businesses need money to operate, grow, and achieve their goals. 2 primary sources of financing are equity financing and debt financing. Equity financing involves selling ownership shares in the company in exchange for cash. This could include selling stock or seeking investments from venture capitalists. Debt financing involves borrowing money that must be repaid with interest. This could include bank loans, lines of credit, or issuing bonds. Each financing option has its advantages and disadvantages. Equity financing does not have to be repaid, but it dilutes ownership. Debt financing must be repaid with interest, but it does not affect ownership. Valuation ratios, such as the price-to-earnings or PE ratio, help investors determine the value of a company's stock. Section 10. The bottom line: mastering your financial destiny. Understanding accounting and finance is not just for accountants and financial experts. It's essential for anyone who wants to succeed in the business world. Whether you're an entrepreneur launching a startup, a manager making strategic decisions, or an investor seeking profitable opportunities, a solid grasp of financial principles is crucial. By mastering these concepts, you equip yourself with the knowledge and tools to make informed decisions, manage your finances effectively, and ultimately achieve your financial goals. Remember, knowledge is power, especially when it comes to your money.